Hello, everyone. Welcome back for another Fratarcangeli Friday market update. And no time for the weak and weary as things are up and running with a conflict now that kicked off on Saturday with the United States and Israel attacking and striking Iran. A long, drawn-out discussion that was going on that came to this. And what's happened and transpired this week is a great deal of volatility. I know that we've talked about volatility coming, and we never know exactly what's going to cause volatility in an election year and a second year of a first-term presidency. It's always unique, and here we are. And what we've seen transpire is essentially oil prices jumping from somewhere around $60 a barrel all the way up to close to $90 a barrel in a matter of 4 to 5 trading days. That's a big move. And there's some concern that this could go as high as 150 if this situation continues to go on for substantially longer. And of course, the strait that the oil rigs are coming through is certainly open, but it's causing a lot slower movement and insurance costs going through the roof. And let's not forget that China, who has relied upon Iran and as well Venezuela for their oil supply, and unfortunately are offline in both cases, are now getting their oil from the Saudis. I think we need to also look at the fact that the U.S. dollar has elevated substantially this week because of the fact that now the BRIC nations, Brazil, Russia, Iran, China, and as well South America, are now buying oil through call it Middle East and using the U.S. dollar as opposed to the BRIC, call it counter to the U.S. dollar. And that's driven the dollar higher. And what we're seeing basically is that the United States has stepped in and they're really controlling the order and getting the dollars back being purchased from the U.S. side of currency. And I think that could be perceived as a positive relative to the U.S., generating and definitively defining the order, but there's certainly some watching of that scenario. And I think if I have to be so bold, we have to also consider, do other countries get involved? As we hope that this isn't going to be a forever war like our history has brought in different wars throughout the United States going back over time. And we're hoping and praying for this to be a swift end. But I know that our president came out earlier today and made statements that barring a surrender, they're going to continue to move forward. So that, of course, has caused the market to create heightened volatility. Something we call the VIX, or the fear index, has certainly been elevated, and we're keeping a close eye on that. Personally, I think this is something that isn't going to be over tomorrow, but it isn't going to be as drawn out. We'll be monitoring that very closely and certainly praying for those that are being affected in the Middle East by this situation that I think will come to an end nearer term. In addition to that, we had some unemployment numbers come out this morning, and the numbers came out 92,000 jobs lost as opposed to 50,000 jobs created. And I think there's two somewhat isolated categories that were affecting this number more so than the broad, call it, employment universe in the United States. And that's the government jobs, and that's the strike that Kaiser in the healthcare category and sector that caused about 30,000 jobs to come offline short term. We are definitely keeping a close eye on that. If there's any silver lining, it's the fact that the Fed will probably lower interest rates maybe a little sooner. And based on that information, we're now calling for a July rate cut. And we're also expecting an additional rate cut later in the year. We're also seeing that the mortgage-backed or mortgage rates have come down here in the last, give or take, 6 months. And we're seeing rates drop below 6%. And I think there's a direct correlation there with the Fed's next move, and as well the fact that the government is now buying these mortgage-backed securities and bringing the spread down across, call it, interest rates in general on the long term, which effectively is affecting mortgage rates, which affects all of us across our desire and need to potentially refinance or make new purchases. So I see that as somewhat of a silver lining as well. And we have to keep in mind that we've seen some pretty strong numbers come out of the ISM, both on the service and manufacturing. And I would say that really calls for and shows us the fact that we have high degree of productivity. As we watch the jobs number as a counteract to that, I think there's some positive things in the, call it, silver lining of what we're seeing in this domestic economy, and I think ultimately global economy, and some positive factors that productivity brings to the table. So we'll be watching that very closely. Inflation being under control and productivity on the uprise. That is a very positive take as it relates to the overall economy here domestically. And we also have to look at earnings, which just closed out for the fourth quarter. And we're looking at 13+% earnings growth year over year, which is once again a very strong number. That's the fifth consecutive quarter of double-digit earnings growth and the ninth consecutive quarter of earnings growth in general. This is all very positive. And what we're also keeping our eyes on as we see this market consolidate, specifically in technology and AI, we're seeing that the price to earnings ratio, or the PE ratio as we refer to it, which is being monitored very closely, as we've known that the historical levels of PE ratios being somewhere below 20 times earnings, and we're looking at the current projected earnings for the year with a PE ratio at around 22 times earnings, which is certainly elevated. But I also think that with the strong earnings growth that we're anticipating for 2026, along with the fact that some of the more growth areas of the market, specifically tech, industrials, we're seeing those PE numbers, price to earning numbers, come down very similar to the levels of the overall market. By 24 times earnings. And we're looking at companies that are blowing through their earnings estimates and projecting higher. And I would see that as a clear sign that we're going to get continued expansion in valuations. And I think the earnings will be the driving force on that, as well as the Fed and interest rates coming down. Of course, we're watching very closely what's happening with the conflict in Iran and the cost of energy being impacted, which we'll see and monitor very closely how long this goes on. Those could play into some of the headwinds that could deteriorate some of those earnings. So, of course, we are, I would say, confident with some caution across the board. And listen, we've talked, many of you, on an individual basis, and we've also spoken to you in these Friday market updates, and we're going to be doing another market update on a more broader interview near term, just to double check our work. But we've talked about the fact that we anticipated volatility. We anticipated the second year of the first term presidency being the least rewarding of the 4 years. We also talked about the fact that the third year is typically the most rewarding. So let's maintain our plans. Let's have a understanding of what our liquidity needs are. Let's understand what our discretionary income capabilities are. Let's continue to dollar cost average and take advantage of the emotional market that tends to be the case in the second year. And let's stay the course. Let's understand what our intent is and what our objectives are individually and for the longer term, and understand that this is a part of the journey. We're here monitoring this, focused on what we should be doing opportunistically and as well defensively. And I believe we're positioned very well, and we'll continue to focus on that here at Fratarcangeli Wealth Management. And we're honored to be a part of your team. And I thank you for joining us for this brief update. And I look forward to talking to you soon. And we'll be all hands on deck, making sure that we're thinking bigger and longer term. Bye for now.